Hello traders. This is a video I've been wanting to put together for a while that I mentioned last week that I was going to be working on. It's just taken me a lot of time to get together all the material I wanted to cover with you guys. I may even have to make this be a two-part video just because there's just so much I want to try to cover and not sure I can do it all in one video. But this is probably the most important video I think of out of all of these, because we definitely need to understand what the risk is in selling puts. I think it's a very lucrative strategy, but at the same time that does come with some risk associated with it. So I want to make sure everyone is completely aware of what that looks like. Before we get started, I would suggest going out to my YouTube channel and watch the video that I made last week, selling puts, how much money can you make? Because this is basically going to be a follow-up to that. And then also, if you scroll and look for a video that I posted about 2 years ago, it's called Margin Accounts Using Margin with Options. I would suggest watching that video as well, because I'm going to be talking about margin accounts and buying power, and I go into a lot more detail there exactly what that means. I won't be covering that again. I'll be using a similar spreadsheet that I used in that video, but I think it's valuable to go watch that video as well if you're new to margin accounts and buying power. So what I want to really focus on in this video is worst case scenario. So basically there's two situations that I would consider worst case scenario. The first one would be to lose more money than your account balance. So I want to look at, is it possible through selling puts that you could actually owe money and actually have to pay your broker more than the cash you have in your account to cover your positions. And then the second worst case scenario would be kind of the next level down. You just lose your entire account balance. So you don't have to pay more, but you blow up your account and wipe out your entire balance. So that's kind of the two scenarios I want to focus on. So before we look at those worst case scenarios, I wanted to see what would a worst case look like back in March timeframe of this year when we had the crash due to the coronavirus. And so I pulled the closing price for SPY, Citigroup, and Delta Airlines. I'm not sure if you can see the tabs at the bottom, but those are the three that I pulled. And the reason I chose Citi and Delta is because they got hit really hard with the drop. They both dropped over 50%. So I was kind of looking again at some worst case scenario stocks and as well as SPY. And I pulled information for up until last week, I believe it was. So for 89 days. And the day that I started was at the peak of the market. So it was February 13th when the market started dropping off due to the virus. And so what I did is first I wanted to look at the cumulative drop and then the daily percent drop. So what does that mean? So I wanted to see, okay, from February 13th, looking at each individual day, how much had the market dropped from the 13th? And I highlighted anywhere we had more than a 20% drop from February 13th. The daily drop is just looking at the percent drop between 2 days. So for example, between the 20th and the 21st, it was a 1% drop in the market. And I highlighted in red anything that was over a 10% drop in a day. So what we can see is that, SPY eventually dropped 33% from its high. On March 23rd was when we hit the low, and it was down 33%. But it took 27 days to get there. So it wasn't like we had a 33% drop in one day. I mean, you can see we had, after 6 days, it was down 1%. Then it was down 4% the next day, down 7%. And again, these are totals. So it wasn't like, I'm not saying we dropped another 7%. We dropped basically another 3% to where now we're down 7% total, 11% total, 12%. It came back up a little bit. And then eventually on the 20th is when we broke the 20%, or sorry, on the 20th day is when we broke the 20% level. And you can see we stayed down below 20% until we hit the 33%, and then it started coming back up to where on day 39, on April the 8th, we finally got back above 20%. And as of last week, we are back to only down 8% as of June 19th from the peak on the 13th. And then the interesting too, on a daily basis, we only had one instance where the market dropped more than 10% in one day, and that was on March the 16th. And that's when we had, a pretty significant drop where we were down 20%, and then the next day we're down 28%. So we had a 10% drop, and that was the only 10% drop for SPY. So why am I looking at this? So the point I'm trying to drive home is, when we think about black swan events, like, oh, what'll happen if my portfolio drops 25% or drops 50%? And just looking at this, there was never a scenario where we had a 25% drop in one day. It took it 19 days to get to a 20% drop, and we only had one instance of a drop greater than 10%. So those are things we need to look at when we're considering about, how much can our portfolio realistically drop. Those type of scenarios of a 25% drop in one day just really isn't realistic, at least as it pertains to SPY. If we jump over to Citi, looking at it in the same fashion, you can see Citi, it took it about 15 days below a 20% drop. And it did have a few instances where it was greater than a 10% drop in one day. You can see on the highest one was on March 16th, it dropped almost 20% in one day. And we had a 16% drop here and 14% drop here. And Citi eventually was down at 55% at one time on March the 23rd. So again, a 55% drop was huge, but that's not a one-day drop. That took it 27 days to get to that level. And as we'll see here in a second, we'll be forced to get out of our positions well before we get down to these levels, because we'll have a margin call at certain percentages to where we would never have a situation where we would be in this position at a 55% drop anyway. Delta is probably the worst of them all. You can see it broke 20% on the 11th day, and it did have some pretty significant one-day drops. It had a 21% drop, 11%, and then we had this big one here, almost 20%, 26% drop on March 18th. It went from 31.74 to 23.49, and it got to where it was down 63% at one point in time. And it's still, still down pretty significantly. I'm trying to look to see. Oh, actually, we got down 67% on May 14th. So now it's back to where it's down 50%. So anyway, I just wanted to show you these three, just so we can kind of set a baseline of what's the potential of a one-day drop. And in case of SPY, there's never been more than 11% drop in one day. I think even back in the financial crisis, there wasn't a one-day drop of more than 11%. And you can see for individual stocks, again, it's pretty rare to have a drop that would be, more than 15, 20%, except for Delta's case. We did have that one 25% drop in a day. All right, so now let's jump into the spreadsheet that I have. So you will recognize this spreadsheet from the margin account video that I mentioned earlier. And what this allows me to do is to put in specific ticker symbols, what their current stock price is, the strike price that I sold, the expiration month, how much of a credit did I receive, how many contracts did I put on, and then it will calculate the buying power reduction for me. So for example, if I put one contract for all of these, it's going to calculate how much buying power is needed for each one of these positions. And the formula that I'm using to calculate this, you can go search, you can Google for, in my case, TD Ameritrade is my broker. I Googled their margin handbook. So you can see this is their margin handbook. You can see up top, that's the URL if you want to go look at the PDF. But if we scroll down to page 11, there's a section for uncovered equity options. And it gives you the three formulas that they use to calculate your buying power, and they give you some examples for those calculations. So that's the formulas that I'm using for my spreadsheet. Notional value just means how much the stock value is, or how much you would be on the hook for if you had to buy the stock. So for example, doing one contract for each of these positions equates to $31,800 worth of stock. So if you were assigned every one of these positions at the strike price, that's how much it would cost you, is that $31,800. So the stocks that I have here are the ones that I put on back in early June, and I sent them out in my trade alert email. And I wanted to use these because this would be a good example of where I'm putting on 6 positions at once. So that's a pretty significant amount of buying power. So I just want to look at a scenario where I'm putting on a lot of trades, and what would happen if we had some pretty big drops in the market when I have on this many trades. So I want to look at the different percentage buying power that we looked at in my other video about how much money you can make, as well as cash secured. So let's start with cash secured. So to figure out how to do cash secured, in this case, I'm using a $25,000 account. For it to be cash secured means that I would want the notional value to be no more than the cash in my account. That would make it be cash secured, meaning that I would have the cash in my account to cover purchasing all these stocks at the strike price. In this case, I would not, because it would require $31,800. So that means that I would not be able to do one contract of every single one of these positions. So let's take off this Chewy one. You can see that brings me down to 27,750, and let's take off this lift trade. Okay, so that's pretty close. 24,800 is right at 25,000. So that means that this would be considered cash secured. Another interesting thing you'll see is that it's using 16% of buying power. So that's kind of a good gauge. If you have a cash secured account, then all you can do is cash secured. But if you have a margin account, you can still do cash secured, but it can sometimes be difficult maybe to figure out how much of your buying power to use to be kind of equal to a cash secured account. So here, this is a good indicator to use. Basically 16%, roughly 16, 17%. If you use that much of your buying power, it's going to be the same as if you were doing cash secured in a cash account. And that's why, if you remember from my video last week where I showed how much profit you can make, the profit that you can make from cash secured and 20% buying power wasn't that much difference. You could only make just like a few more percentage return a year by going up to 20% buying power. And this is the reason why, because cash secured is equal to 16% buying power. Going up to 20% buying power isn't that much of a difference. Now let's go over to this other tab that I have. It's the same information from the other tab, but what now this allows me to do is look at different percent drops for each position to see how it will affect my buying power. So for example, I can go in and put, let's say, a 25% drop for every stock. And this ties back into why I wanted to look at SPY, Citi, and Delta earlier, because again, a 25% drop, this would have to happen, basically in one day for these circumstances to occur. And again, as we saw, there was only one instance, and it was for Delta, that there was a 25% drop in one day. So really, this is probably not a very realistic scenario, but I just want to show you that if all your positions drop 25% and you were trading, the equivalent of cash secured, your buying power would still, be relatively low at 37%. If you wanted to close out your entire positions, it would cost you $5,000 to do so. So you would basically lose $5,000 to close this out. So I can come over here and say I want to close out each one of these positions. That would be a $5,000 loss and leave me with a $20,000 balance if I decided to do that. Okay, what if we get a 50% drop? Again, you can see that your buying power is still safe. And if you wanted to close this out, you would lose about half of your account. It would cost about $11,000 to close it out. And let's do 75%. Still fine on the buying power, and it would cost $18,000 to close it out. And then lastly, let's say 100% drop, which means everything's going to zero. The world's coming to an end. And you could see you would basically lose your entire account. So your buying power would go in the negative, so it would force you to close out your positions. You'd pay $24,800 and you would lose your entire account. But you would not lose more than the value of your account. You wouldn't have to actually pay more money in a cash secured situation. Now let's go look at 20%. So I'm going to add these positions back. You can see now I'm at a 20% buying power, which means that I am on the hook for more stock than I have cash in my account, but it's not much more. It's almost $7,000 more. And again, the stock would have to go to zero for me to have to come up with that $31,800. So let's go look similarly. Let's look at a 25% drop in the market on all the positions. You can see the buying power is still low. It would cost about $6,000 to close it out at this point. If we go to 50, a 50% drop, we're at 74% buying power, and it would cost $14,000 to close out the account. Now at 75%, you can see our buying power goes into the negative. This is when we would realize a margin call. So at this point, we'd have to start closing out positions to get out of the margin call. And you can see right now, still, you would not have to pay more money than the value of your account. It would cost you $23,000 to get out at a 75% drop if you closed out your entire positions. Now, if we change this to 80%, you can see that 80% is when you would actually start losing more than the cash in your account. Be $20 more. And again, keep in mind, this is like an instantaneous drop. You'd have to have all your positions drop 80% for it to be a situation to where you would lose more than the cash in your account. All right, now let's look at 40% buying power. So I'm going to do 2 contracts for each position. And let's look at a 25% drop. Okay, so using 40% buying power, even if there's a 25% drop in one day in all your positions, you would still be okay with your buying power. I mean, it's getting really high. It's at 94%, but you're in a situation where you would not be in a margin call, and you could still stay in these positions and keep rolling them and would not have to worry about closing anything for a loss. If you did decide to close these positions at this point, because maybe you thought the market was going to continue to drop and you just want to close out your portfolio and be in cash, it would cost you $12,750 to get out. So basically you would lose half of the value of your account if you decide to close it out after a 25% drop across the board. Now if we look at 50%, now you can see a one-day drop of 50% would put you in a situation where you would lose more than the cash you had in your account. And the exact number for that is 44%. If we look at 44%, you can see 44% is when you would start having to pay more than the cash you have in your account to close this out. So if you thought that there was a possibility to have a 44% drop in your account in one day, then using 40% buying power is not, would not be something I would suggest. If you thought this was something that was realistic to happen in one day, you'd be forced to close it out and have to pay more than you have in your account. If we look at when the margin call would occur, that occurs at 28%. So you can see with a 28% drop, that's just when your account would go into the red for your buying power, and you'd have a margin call, and it would force you to start closing out contracts to get back into the green on your buying power. So anything less than that 28% drop, you'd still be okay holding your positions. Now let's look at 60% buying power. Okay, so 25% drop. You can see immediately, you're way into the red on your buying power. But if you were to close this out, you still would not be losing more than the value of your account. You'd be losing a good chunk of your account. It would cost you $19,000 to close it out, but you wouldn't have to pay more if there was a 25% drop in the market. It's at 31% when that would start to occur. Anything above 31% in one day, you would have to pay more to close this out than you had cash in your account. And it's at 13% when the margin call would occur. So you can see at 13%, that's when the buying power would go just over 100, and you'd have, your buying powers in the red, and you'd have to start closing out some positions. Now let's look at 80% buying power. So 80% buying power, if we go to 25% like we've done on the others, you can see a 25% drop is where you would start actually having to pay more than you have cash in your account. This would cost you $25,500 to close it out. So anything over a 25% drop in one day, you would have to pay more to close this out. Because again, your option buying power in this case is so far in the red, you'd pretty much have to close all these positions out. Like if I close, let's just see how many I have to close out to get back into the green. So even closing out all those positions, I'm still 3,000 in the red. So I'd have to close out everything, and I would realize that loss of $25,500. So I'd be minus 500 cash in my account. The percentage where the margin call first occurs is at 5%. So you can see with a 5% drop, that's when you would your buying power would go over 100%, and you would be in the red to where you'd have to start closing out some positions. So these are all kind of worst case scenarios. Again, I started each one of these looking at a 25% drop in one day in every single one of these positions. And again, based on what we looked at earlier, the only stock based out of Delta and the Citigroup and SPY, Delta was the only one that had a 25% drop in one day. So it's not realistic, at least in my mind, that every single stock will drop that big of a percentage in one day. So let's look at a more realistic scenario. I'll keep using the 80% buying power. And let's say, again, because if we go back and look at those stocks, in the case of Delta, it took it a few days to get to where it was, between around 8%, 13% drop. So let's look at a scenario where we had a 10% drop in one day, which again would probably be more of a realistic scenario versus the 25%. So you can see with a 10% drop, there's going to be the margin call. So you're going to be forced to start closing out some of your positions. So let's close out this one. Okay, so all I had to do was close out two positions. Now my buying power is back below 100%. So in this scenario, I'd probably roll my positions into the next week. And let's say the next week or over the next few days, it drops another 10% for the remaining positions. So now these positions are going to be down 20%. Okay, I'm back into a margin call again. So I got to close out some positions. Let's close this one out, this one out. All right, now I'm back below 100%. And now let's say the last two positions that are left drop another 30%. Have a margin call again, so I close out this position. I'm back below 100%. And my last position, let's say it goes to 40%. I'm still okay. And then it goes to say 50%. I'm in a margin call. I close it out. And I'm done. So in this scenario, I'm using 80% of my buying power. If we go back and look, I'm at 80% buying power. And when you look at a more realistic scenario where it drops in, say, 10% increments every day, you still lose the majority of your account, but you're not having to pay more than your account. So going back to the original slide where I had the two worst case scenarios, the worst case scenario where you could end up owing money more than your account is highly unrealistic in my point of view, just because you're not going to have those big drops of 20, 25, 30% in one day to where you'd have to close out your account that day and you would lose more than you had cash in your account. It's going to be a gradual decrease, and as the drop happens and once you start getting those margin calls, you're going to be forced to close out contracts or whole entire positions before the drop gets big enough to where you would even have that situation. And again, we're using 80%. So if I went back and did this for 60% and 40%, it obviously wouldn't be as bad as this. You'd still have some cash left over. We can go look at 40% real quick. And let's go ahead and jump up to a 30% drop. So here's where we would have roughly our first margin call. So I will go in and close out this position here. We're back, it's still pretty close, 99%, but I'm going to leave it as it is. And let's say the next, there's another 10% drop in all the remaining positions. Now I got to close out a few more contracts. So yeah, I pretty much had to close out all the positions. I can leave one left, and let's say this goes down to 50%, 60%, 70%. Okay, so that's when we'd have our next margin call, and then I close it out. So again, you can see that in these scenarios, you still would lose pretty much the majority of your account, but you would not be in a situation where you have to pay more than the value of your account when you have these kind of incremental drops, which would be typical of what we would see even in a crash situation. The market is going to drop, 5–10% a day over several days, not one big drop of 40 or 50% a day. One other thing to note is I don't use this spreadsheet when I'm trying to determine how much buying power I'm using. I really just put together this spreadsheet for the purpose of the margin account video that I mentioned earlier, and as well as adding these additional columns for this video. I'll show you how I just kind of rough estimate what my buying power usage is. So this is a paper account. You can see I put on a few trades just so I can show this as an example, but in the top left corner here, you can see it says option buying power 48,700, and then cash and sweep vehicle 107,000. So to calculate my buying power, this option buying power is how much I currently have available. So if I bring up a calculator, all I need to do is say, 48,715 divided by the 107,300 times 100 to make it a percentage. That means I have 45% of my buying power left. So if I have 45% left, that means I'm using roughly 55% now. So that's kind of how I calculate my buying power and I can pretty much get a rough estimate, just do it in my head. If you have a $100,000 account, it's pretty easy. If you want to use only 70% of your buying power, then you would need to have about 30,000 of option buying power left. If you want to use 40% of your buying power, you would need to have about 60% or 60,000 of your option buying power left. So again, you don't need, the spreadsheet is nice as far as you being able to see, pretty quickly what your buying power percentage is. But for me, I don't want to take the time to have to key in all my positions, key in the stock price, key in the strike price to calculate it here, when I can just easily do that math that I just showed you based off the total account value and not have to do that on an individual stock basis. So again, you don't really necessarily need this spreadsheet to determine how much buying power you use. It was just easier for me to use the spreadsheet for this explanation purposes. So what are some ways that we can reduce our risk so that we're not faced with those situations where we could potentially blow up an account or lose a significant amount of our account? So I just put together some bullets of some ideas to consider. The first one, which is one of the ways that I do this, is regularly take out profits. So I'm constantly taking out profits every month, so in the event that something does happen and my account does blow up or does drop, I know I have those profits that I've already pulled out, and I can put them back in again if I need to cover a margin call. If my margin call is 5,000 and I've already pulled out 5 or 10,000 in profits, I could put that money back to cover that margin call. The second one I have is buy a hedge. So you could buy say some SPY puts or some VIX calls to hedge your portfolio. I actually ran some simulations using hedges back in March just to see what it would look like in a portfolio that was mostly selling puts. And that's what I think part 2 of this video will be when I make it, is showing you that simulation and how if we'd have had on a hedge during that time, that it would allow us to get through the market drop without losing anything at all. Next one, move to cash in periods of unexpected volatility. So that's another option, and actually is what I did into February, is I just moved to cash when the market started dropping. And for me, it was mostly because I didn't want to risk, again, losing or blowing up my account, especially thinking that I may need that money to live off of just because my job was affected by COVID. And I thought that I may need that money to cover some expenses for a few months. So I just moved to cash just to avoid all the volatility in the market. Of course, that meant taking a loss, but obviously it was a lot less of a loss than I would have taken if I'd have waited till later and possibly have to, lose my entire account. So again, anytime there's some unexpected event that comes up and you feel like it's something that could continue to go on and make the market drop, you just move to cash, take the loss, and wait for the volatility to settle down. The next one I have is move to cash for non-events. So like if a Fed meeting's coming up or we got the election in November, if you think it's going to cause a lot of volatility, just go ahead and move to cash and wait till that event is over with, and you can just see how the market reacts to it. I moved to cash a few times last year when we had a few Fed meetings and there were some China tariff meetings going on around that time that we knew in advance when those meetings were going to occur. I would go to cash before those meetings, and it actually did save me a lot on those because on several of those occasions, the market took a big drop after those meetings and allowed me to get back into the market at a much lower price for selling puts than I would have been if I'd have kept selling puts every week. So don't be afraid to be in cash. Don't feel like you have to trade every single week. The next one, use a mix of calls and puts or just calls when the market is overextended. So I think I'd mentioned in another video earlier this year in January, the market was very top heavy and I was already starting to add some call spreads to my trades just because I felt like we were due for a pullback. Now I had no clue that we were going to get as big of a pullback as we did due to the virus, but I was expecting some form of a pullback. So I was using less of my buying power selling puts and allocating more of that to selling calls and call spreads. So don't feel like you have to stick with selling puts as your sole strategy. I mean, you want to trade what the market gives you. And if the market is really top heavy and you're scared there could be a pullback, either don't trade at all. If selling puts is the only strategy you plan on using, just stay in cash until you get a pullback, or start adding some calls into the mix. So that way, if there is a drop, you have a smaller percentage of your buying power allocated to puts, and you're also being able to profit off of those calls that you're selling. The next one is, use less of your buying power percentage when the market is overextended and increase it when markets pull back. So, again, like if you think the market is really overextended right now, maybe you want to be at a 20% buying power. And then when the market does have a big pullback, that's an opportunity for you to go in and maybe increase your buying power from 20% to say 60% so that you can capitalize on the fact that the market's lower. It's going to allow you to get your strike prices further away than you would have been able to earlier when the market was higher. And you'll get higher premiums because, when the market drops, the premiums go up. So again, you can adjust your buying power percentage. You can keep it low when the market's overextended and then increase it when the market pulls back. I've also seen where traders use the VIX as a gauge of when to increase or decrease buying power. So some traders will say if the VIX is really low, they want to keep their buying power percentage low because they're expecting at some point, volatility to increase. So you don't want to have your buying power percentage at 80% and then there'd be a big increase in volatility and then it forces your buying power to go over 100%. So some traders will use VIX kind of as their gauge to know how much buying power to use. I've also heard kind of the opposite of that, like to use more buying power when the VIX is low And then when you start seeing the VIX increase, that's when you move to cash and try to stay out of any high volatility situation. So you can really look at it both ways. Keep your buying power low when the VIX is low, or keep it a little higher, and then when the VIX moves up, you could then start trying to scale out of your positions, waiting for the VIX to drop back down. The last one I have is use technical analysis. So again, technical analysis is not going to be able to predict a black swan event or predict some unknown crash like we had earlier this year. But I think technical analysis can help us, for at least individual stocks, determine if a stock is overextended or could have a pullback, and that's just another tool in your toolbox. So lastly, I want to just look at what are our takeaways. So the first one there, black swan events like the one this year can blow up an account if selling puts. But I also know, this applies to any bullish option strategy, buying calls, put credit spreads. A lot of people think credit spreads are safer because you have defined risk. But if you'd had, 80% or 100% of your account in nothing but put spreads when the market crashed in March, you'd have blown up your account because every single one of your spreads would have been at max loss, and there'd have been no way for you to roll them or recover them. So you'd have been in a similar situation if you'd have been just selling puts. Again, that's assuming you would have been using the majority of your account for your credit spreads. And again, buying calls, no different. If you'd have had majority of your account just buying calls, you'd also lost a lot of money as well. The second bullet, even during a black swan event, it would be highly unlikely to lose more than your account value. So I think we saw, in that spreadsheet, looking at more realistic percent drops where maybe it's 10% a day, not anticipating those huge drops of 25, 30, 40% in one day, that when you have it kind of increment day by day, that it's highly unlikely that you could lose more than your account value. You would more than likely blow up your account, but you wouldn't have to owe any money after the fact. And then what I have here is just showing you for each buying power percentage, how much of a drop would be required for you to get a margin call, and how much of a drop would be required for you to get to lose more than your account balance. So you can see if you're using 20% buying power, you would need a 70% drop in one day of your entire portfolio to get a margin call. And you would need an 80% drop in one day for you to lose more than your account balance. For a 40% buying power usage, you would get a margin call after a 28% drop in one day on your account, and you would lose more than your account value if there was a 44% drop in a day. If you're using 60% of your buying power, you would get a margin call just after a 13% drop in a day, and you could potentially lose more than your account balance if there was a 31% drop in a day. Because then if there's a 31% drop in a day, you would have to liquidate all your positions. And by liquidating all your positions, you'll end up having to pay more than the cash in your account. But that would be, it'd be a pretty significant drop in one day. And then at 80% buying power, you'll get a margin call with a 5% drop in a day. And then you would lose more than your account value if there was a 25% drop in a day. So like in the case of Delta, if you'd have sold a put in Delta on that day it dropped 25%, and that was the only stock you were trading. Let's say you used 80% of your buying power to sell puts in Delta. And that on that day that it dropped 25%, you would actually have lost more than your account balance. So that's, another reason why, you don't want to put all your eggs in one basket, so to speak. You want to be able to have multiple positions on, because the chances of every single one of your positions dropping that much would be highly unlikely. But again, we're talking about worst case scenario here, so that would be a possibility that you could lose more than your account balance with that type of a drop. So that's all I have for this video. What I was thinking about for part 2 is, as I mentioned, I ran some simulations. Not sure if you're aware of this, but in the Thinkorswim desktop app, there's something called On Demand. You can see up here in the top left. The cool thing about On Demand is it lets you go replay any day, and you can trade that day as if it was, live trading. So up here you have a calendar, and I can change the calendar and go back to say, okay, I want to trade on February the 13th when the market first started to drop, and hit go. And it takes a little while to buffer. So now if we go pull up a chart, say in SPY, you can see this is when SPY was at its peak at 337. So if I wanted to, I could go in and place a trade And see, it's giving me all the option change starting back in February. And let's say I wanted to go buy a put in April. I could go and I could buy a put. Sorry, this is SLIF. Let me change it to SPY. So we'll go out to April. And let's just say I wanted to buy a put for a hedge. Let's say I do the 296. I can buy it for $1. Hit confirm send. And you can see it actually enters the order and executes it just as if I was trading it live on that day. And then I can move forward in time to see how did that position do. So if I wanted to go to, let's say, a month ahead to March, if we go look at a chart in SPY now, you can see we have that big drop off, where that was the low at 228. So if we go look at my position that I bought, I had put on a lift position earlier just playing around with this, but you can see this SPY position, I have a profit of $54,000 on this SPY position, and it only cost me $1,000 to buy it. So if we look, my trade price was $1, 10 contracts is $1,000. I could now sell this for $55. That's $55,000. So in this next video, what I want to do is I've already run through some simulations, but I want to run through them again, just showing you what this would look like if I had sold puts in 4 or 5 stocks like I typically do, but also if I had included a hedge like with SPY, just to see what the outcome would have been. So I'll try to do that in my next video. I would appreciate it if you like and subscribe, and let me know if you have any questions. Thanks.